Welcome to Sachs Realty's Tuesday Night Podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our Tuesday Night Live. We got a hot show lined up for you tonight. There is so much to talk about. Credit tightening, bank collapsing. I think I said that kind of funny. Bank collapses. The banks collapse. I don't know. Guys, it's 8 o'clock here on the East Coast. I've been working since like 4:30 this morning. Very tired, but I am so happy to bring Alisa Glutz back to you tonight. She is an author of a book called Color My Credit. She has a mortgage business. She helps people buy houses, and there's a lot going on with mortgage news right now. I mean, rates kind of tumbled a little bit, and now they're headed back up again. We're going to talk about what's going on. We have FHA talking about 40-year mortgage modifications for people suffering, paying their mortgage. We're going to talk about who gets the money. That's what I want to know. Who gets the money for all these loan modifications? Does the government get it? I mean, what's the benefit here to casting a loan balance to a 40-year mortgage? We are going to also take some live callers tonight. I'm really excited about that, guys, because last time we had a surprise, man. Somebody jumped on from India. Remember that, Melissa?
How can I forget? I mean, yeah, we had
kind of fun.
It is. I love the live calls though. I love having them call in and give their insight on what's happening. And sometimes it's really hard to listen to. People have been having a rough year. Yeah, it's hard time. Mm-hmm. So looking forward to hearing from some people tonight.
So the way that works, guys, is we have a link in our show notes. It's pinned at the top. If you're watching us on YouTube, if you're not, I would recommend that you check us out. Sachs Realty's YouTube channel. Jump on that link. You're going to go into a little waiting area where we will pull you up one at a time, take you live on our show tonight. But we will also take your comments as well. I see comments are starting to stack up. We want to hear from you. We want to answer your questions. And without further ado, ladies and gentlemen, let us bring in Alisa. Alisa, thank you so much for joining us again. This is like your at least fourth time.
I know. I feel like this is like Johnny Carson, and you're like, invited me to sit at the chair with you. That was a big deal for stand-ups back in the day. Anyway, that's an old day. Now it's real estate. No comment.
You did a little stand-up.
I mean, I was on the other side. I wasn't funny. I was very good at laughing. And so I was a producer on Politically Incorrect with Bill Maher back in the day. And then I worked for HBO, and I was a stand-up expert way before my mortgage life. When I knew what was funny in my 20s. Now I just, no.
How did you get sucked into mortgage?
Well, my mom was in the business. It was the thing I wasn't thinking I was ever going to go into, but I married somebody who wanted to come back to Arizona and start our life here in 2003. And when I came back here, I thought, God, what am I going to do here? That's funny, but the mortgage business turned out to be hilarious. So it was great. And I just built my business from there. And I knew it was something that was 100% commission. And you kind of got the ability to help people through something that was really complicated. And I got excited about it. So I've been doing that for 20 years, but about 10 years ago, I started, after the last crash, I started teaching a lot of Dave Ramsey's stuff to real estate offices. And as I got into his Financial Peace University, once we got to kind of near the end, I kind of stopped the tape and said, whoa, we can't cut credit cards up. We got to learn how to use them to make them work for you, because unfortunately they're like your quarterback, running back, wide receiver. They're necessary, but we got to learn how to use them. And so he didn't agree with that, obviously, different philosophy. So went on my way and wrote Color My Credit. It came out in 2016. It's kind of my solution to, it's the opposite of credit repair. and Melissa and I were talking about it earlier, what most people think is they need to fix something they did in the past when their scores are low. Like they got a 30-day late in the past, they got a charge off in the past, they had a collection, and they completely miss that they need a team right now, today, reporting on your behalf good financial decisions, like that you only owed $20 out of whatever the limit was on the credit card. That makes you look low risk, and like that you know that you are in charge of your life, disciplined in your life. And that's the fastest way we see the scores go up. But there was a lot of confusion. There were so many different credit scores being handed to people that nobody realized that there's a very specific score that mortgage lenders use when you go to buy a house, and a specific score for an auto loan. And it's none of the free ones, and it's none of the ones our banks give us. So I just try to make it more simple and interesting, but help you understand how to really get to the goods, figure out what you got to do quick.
Melissa.
Hello.
Let everybody know who you are. I'm sure.
Of course I can. Yes. Hi, everyone. Melissa Levy. I am Todd's assistant. I do many things here at Sachs Realty. We've added podcasting to the long list of things, but no, it's great. And I'm happy to be here every Tuesday night with Todd. And it's a great time every Tuesday. And Alisa, thank you so much for being here.
Thank you.
We, value what you have to say. I was just talking to you before the show started on your TikTok, your little segments that you do. And I've learned myself on things about, what you think you should be paying and really where your payment should be going every month. So I definitely think there's a lot of value in that. So there's lots to talk about. The inventory is still low. Talk about the 40 year FHA modification, a lot going on there. So there's a lot of stuff, and you guys have tons of questions. I can see that they're coming in, and we're going to get to them. We're going to get to all of them as best as we can. But yeah, Todd, thank you.
Absolutely. I got yelled at by some listener last Tuesday night podcast. They said that I did not introduce you. Oh. And then, our audience is so good for defending me. They said, you obviously didn't watch the show because it was like 7 minutes in, but hey, we got to, we have to get our guest introduced.
Yes.
Yeah. But it's so great to podcast with you every week, Melissa. I appreciate your contribution to everybody. Just really values what you have to say also. So guys, we are going to, I don't see anybody that has been brave enough to jump in on our live stream. I don't see anybody in the waiting room. So the link is at the top. And, but Jeff M, I know, we talked about you jumping on here. So don't be shy, guys. We want to hear from you. We'll take some questions, but Alisa, I'd like to start out with just kind of talking about Arizona.
Yeah.
Because, we have a lot of listeners from Arizona, and you guys really shot up fast. I mean,
Big
you
time.
were fast and furious, and everybody was saying, Arizona's never going to crash. Prices are never going to go down in Arizona. I think Phoenix is getting hammered. What is going on in Arizona?
You have to think about it this way. You can't really look at any number without looking at the past. And so it's hard to determine, we had an apple about 3 or 4 years ago that we bought for $1. And then suddenly it was worth $100. Okay. And so today it's worth 80. I mean, is it more than $1? Yeah. Okay, is it 100? No. I mean, so I think most people have already seen that it went up so ridiculously high in such a short amount of time that's unseen that it had to come back. But we're not seeing it crash. We're seeing it come back, a little steady. Like I said, I think overall we'll kind of, in the end, net probably a 25-30% increase from before the pandemic and everything. But I will tell you, it's going to be interesting to see. I saw a lot of people buying homes in 2020, and they have a lot of equity now. And it's those people I'm really looking at to see, are they setting up home equity lines of credit right now? because they're not going anywhere. They're so excited about their 3% rate and being at every dinner party and saying, I got a 3.25, so I'm good. They're never, I have people say, I'm not going to buy a new house because can I keep my 3% and just move the loan to the new house? I'm like, no, you don't get to keep your 3%. Anyway, but I get it. It's just one of those things. So I think that you're going to see, I have not seen, the demand is so high, as we all talk about, that, I was looking at houses under 300,000 in Arizona, because that's about, with your minimum down payment, about a $2,200 to $2,500 house payment. Okay. And if you're making 60, 70,000 a year and you have no debt, that's about what you can afford for a house. Okay. 2,500, right? So what does that equal in a house? If you're going to put minimum down, about 300, with the taxes, with the insurance, with everything. So I did a little looky look. What's under 300,000? It was split into 3 types: single family homes, condos, manufactured homes. Okay. 50-50, or 30-30-30, 33-33. The manufactured, there was only maybe 2 or 3 that really looked financeable, that weren't in a land lease or some kind of a lot where they didn't own the land, different issues, right? The condos, those are going to add the HOA on. So those are going to take up, take down what you qualify for if you add on a $200 or $300 HOA by, you're going to lose 50,000 in purchase power, right? And then if you go to the single family homes, then you go to single family homes under 300. And I think after going through the whole list, half of them were in 55 plus age restricted communities, or Sun City, which is a whole city in Arizona that is age restricted. Like, you can't, not unless somebody's 55, can somebody live there. Okay. So you can buy it as an investor, but you can't occupy it. You have to rent only to at least 155 or older in the house. So the whole city of Sun City is that way. And that's a lot of those, properties.
You can live there being under 55. Here in Maryland, you can. If you're not 55, you can't stay.
No, you can't stay.
That's all occupants. That's not just one.
Oh, not all. No, just one member of the family. I mean, one person who lives there has to be over 55. So that could be younger people. So
you could have a kid. You could be 55 with a 3-year-old. I'm not moving into that community. I'm not going there, man. I don't want to be. So
really, like, at the end of the day, I counted, because I'm looking for several people right now that are like at that level. And there's maybe 4 total in all of the Phoenix, Scottsdale, Gilbert, Chandler, Albuquerque, like the whole area that I could find under 300. So, we're going to have to take it up. And so what do? We've got to either reduce the debt, or you can't just look to a buy down program.
You have to rent.
Right. You rent and you buy real estate in Maryland, Arizona, people. No, maybe not Maryland. Ohio, maybe. Ohio, you can get a steal for 200.
Maybe Peoria, Illinois. I don't know. I mean,
yeah.
Hey, we have a caller. Let's take a caller.
Well,
we got Heidi on deck. Let's talk to Heidi.
Yeah.
Hey, Heidi.
Hi, can you hear me?
We can. How's it going?
Heidi.
Thanks for calling in.
Can you hear me?
Yes.
Oh,
you might be muted. No, you're not muted. We hear you.
I don't think it's going through.
Heidi, try turning your volume up wherever.
Oh, it says recording error.
Oh, we can hear you.
Let's see.
Maybe you can chat with her, Joe. Tell her that we can hear her.
Okay.
She can't hear us, though.
Yeah. Oh,
there she goes. She dropped. All right, guys, we're live. Come on our show. We would love to talk to you, answer your questions. So, Alisa, when we were, I hate to remind you of this. I love you. You knew I was going to ask this question. Yeah. I mean, I know when you said I'm coming on Sachs Realty's live show, I know that you said, "Oh man, he is going to ask me about that 4% mortgage rate that you said would be back in the first quarter of 23."
I listened to the wrong people myself, because everybody, I tell you every day, I'm like, dang it. But no, I don't think we're going to be there for a while. I don't even know how anybody predicts anymore. Ever.
Maybe ever.
I'm thinking, okay, we'll make a bet on this. I'm thinking, I'm going to say before the end of the year. Well, the hard thing is that there's going to be realtors out there that actually are posting right this minute. I can hear them saying, the rates are down to 4%. You know what I mean? It's like every other day. I'm like, don't post about rates, dudes. But
is that the realtors that are left? I think most of the realtors left the building.
I know. I wonder how many there are right now, because I was talking to Chat GPT today. We were having a conversation, and he said at 1.4 million realtors as of 2021. And so then I know that they did do an update with Chat GPT, but it's still only talking to me through 2021. So I was curious where we're at today.
Man, fails us again.
It gave me some facts for this.
1.6 million.
Yeah. I think it lies. Yeah.
Hey, we got Deep Paul on deck. Let's take Deep Paul. We see you. Hey, buddy, what's going on, man? Thanks for joining.
How y'all doing?
Hi.
Good. What's happening?
So, the question I had, and I keep on seeing this over and over again, and I'm in a bit of a different market. We're looking for something more rural and further out, but everybody's concerned about, the rate's dropping 0.4%, and that hasn't even been a concept to me. Overall, the average rate 20 years has been around 7% if you average it. Right. So, I mean, the prices being so high is what I constantly harp on. If it's 150K over and you're at 2% rate, how long do you negative equity?
Well, they don't allow for the negative equity unless you have an option arm, the type of loans that basically allow you to make less of an interest payment than the minimum that's due. That was what we had back in the crash days. They had these option arms where you could make like an interest, a payment based on a 1% interest. Now, that was not going to meet the minimum requirement, the minimum rental fee you were going to have to pay in order to be in debt another month, right? So they took that money and they tacked it on to the end of the loan. And so as the prices started coming down and every month your balance is going up because you're not even making the minimum interest on the loan, now you're upside down. That's what the crash. So we don't have those type of loans anymore. Yeah,
right. We don't have those type of loans. And that's not what my concern as much is for when people are buying the houses. There's a market like a crash because of loans.
I hear you.
I think no matter how we look at this, the values are going to have to crawl back down, even if it's over the next 5-6 years.
I think so.
But, over those 5-6 years, it doesn't matter if I was at 2% or 4%. If I paid $150,000 more than the house is worth to buy in the market. I see trailer houses in flood zones for $400K. It just doesn't make sense.
Yep. I agree. I'm seeing like a year ago when I see properties that were at more expensive. They were $550, but you could get a 3% rate, or today they're at $425, but you're going to get a 6.5% rate all day long. I'd rather have the cheaper house. You know what I mean? Always look at I always tell this, but I bought my house like back in 2017 for $400. At the last minute, I had to get a hard money loan. The mortgage lender had to get a hard money loan, and it was a 12% rate, and I was going to die, but I had to have a house. So I went through it. 2 years later, refinanced to 1.875 on a 15-year, right? And then last year, it appraised at $1 million. I got the house, you know what I'm saying? Get the house, but like get the best price for it, but also be realistic with yourself saying, if I'm going to buy a house right now, it's got to be for about a 10-year, 7 to 10 years. So is it best for me to buy a property that will be my future rental? Because I'm only somebody who wants to live in a home for 2 to 3 years, but I'm not going to be able to sell it in 2 to 3 years if you purchase right now. So I'm going to have to turn that property into a rental to make sense. It's just about being realistic and setting the right, expectations for yourself, I think, and for the market.
And where we're at with the sense of what we want to buy, it's going to be a house we're going to stay in. It's not an investment property. And, and that's helpful in a lot of cases. I mean, there's always things that can happen that can crush that. Yeah. But the sense being, if we're going to have this house, it needs to be something we want to live in forever. It doesn't, we can't compromise on these, this house is cheaper. It's kind of trashy and it's in a bad neighborhood, but, just buying it because we want to buy the house. And that's not how I feel. And as well, talking about, things can crash and burn on your head.
Yeah.
You know, we are
Yeah.
hard nosed stuck at. I am not going over 25% DTI, including my current debt.
That's good. That's the way to do it.
Yeah,
People do not prepare enough for that piece of it. Of everything else, the bank will approve you at this, but
right.
what's your spending like? You know, it's a good call. Like when I see one of those Affirm or buy now pay later type of accounts, and they go, oh well, it's only like 4 payments. But I'm like, but the problem is that you have a history of doing it every month. Like as soon as the 4 payments are done, you start a new one. And then the 4 payments. So I think about it and I go, that is, as much as you think it's a buy now, pay later, only 4 payments, it's part of your budget. You're consistently doing that. And underwriters are starting to say, hey, we're noticing this consistent behavior of them paying this thing every month. We got to add that into the debt ratio. And it's like, what? That's not on the credit. But it's about you got to know, is my child care $5,000 a month? Most of the bank loan programs aren't going to be asking you how much your child care is. So you have to know for yourself, like, can I afford this? Even though the bank says I can afford it. And I think you're smart. 25%, you know, the credit card's under 10% and try to keep your total debt, you know, under 25% as far as your house payment and card debt and things like that, trying to keep it as low as possible.
Yeah, we only use cards just for the point of maintaining a score.
Yeah, set them up to work for you. That's what I preach too. You don't need to go in debt to have a good credit score. You just got to have your game set up.
You know, I know a lot of people too that their payments have changed in the last couple of years. So, I mean, with the tax bill going up and their insurance going up, I mean, I know people that are paying $500-$600
more,
you know, more a month.
Yeah.
For their house. And, you know, they weren't expecting that. I mean, they have, you know, they're utilizing the homestead, you know, credit, you know, Homestead Act, where it's their primary residence, but it still went up because a lot of people don't realize that they were assessing the house at $289 and they just bought it for $475 or more. So, you know, they're getting a hit for that. And then, insurance has been going through the roof, but you're exactly right. I mean, people are going backwards here. And what a lot of people don't realize is, you know, they buy a house and say they're going to stay in it for 5 to 7 years, but life changes.
Yeah.
And, you know, depending on how old you are, I mean, things happen. I mean, people, they get sick. They, you know, I mean, they get divorced. You know, I mean, things happen.
Yeah.
They have a family or, you know, they outgrow the house. And, you know, what's happened over the last 2 years is just, it's terrible. I mean, you know, people are paying what we watched people pay for a home in bidding over 10% over on average over an already overpriced list price. And then, you know, overpaying, bringing cash to the table in negotiations to compete because it didn't appraise, nowhere near appraised. They brought $50, $60, $100,000 to the table of their cash. They are, I mean, I won't say
they
never.
got a 3% on the rest of their mortgage. You know?
Yeah. Oh, yeah. No, look, you know,
that was one of the other hard-nosed limits.
Right. Date the rate, you know, date the rate. Don't worry about the rate, you know. Oh, it's so, you know, whatever. I mean, a lot of people, they are underwater. I think FHA, you know, acknowledges that. We just saw what happened with, you know, I think it was March 8th. They just approved a 40-year mortgage for people that are in trouble, that have been, you know, in default or in and out of default since the beginning of the pandemic. In a lot of cases, guys, I know people don't like me to say this, but you can't keep kicking this can down the road. These people is not going to end well. I mean, extending, and Alyssa, I want to talk about that too. Who makes the money off of this?
Well, I mean, really,
refinancing.
And I'm not to discount your question. I don't know. I guess at the end of the day, don't take this the wrong way, but who cares? I mean, in a way, I'm kind of thinking. I mean, you
want to know who's paying for it,
because I probably would be inaccurate anyway. So like, but I would probably fluff it and make it sound like it, you know. But I guess my point is, let's say at the end of the day, a 40-year modification might bring the payment down $30 or $40 a month. Okay, the fact
or
is,
100 would be a lot.
I'm sorry. Yeah, 300. I didn't mean to say 30.
I saw the average is like 120 or 140
bucks. Depends on your loan amount, but like really, when you amortize it, I don't know. I'm a it depends on your age. And I believe that, look, if you need a couple years to have to modify to a 40-year to not have a late, to not have a foreclosure, from what I understand, though, even the 40-year modification, they want to see that you're at least a couple months behind, showing that you're having a default, having a problem before you can get that. And then, like I said, the best case scenario is that it's going to reduce your payment maybe $300 or $400 a month. How much is that really going to do? That's going to be a Band-Aid. I don't see it being that big of a deal. But I do see, I will tell you that I do see a complete shift in our country soon with FHA loans versus conventional. It's kind of always been in our mentality that, oh, FHA is for first-time home buyers. FHA is for bad credit. Remember when the craze was going on, how the first thing sellers didn't want to see? FHA buyers. They wanted the conventional because they seemed to be more,
first
qualified.
It was VA.
Yeah.
First it was VA.
Any government, yeah.
Yeah. First it was VA, and because VA had a lot harder, more safety.
Appraiser, yeah.
Right. So they had more safety concerns. So sellers were like, I don't want to fix that. And so when they saw a VA buyer, and then VA became great, and FHA became the bad one, right? So as far as the sellers, I don't want a FHA, I'm not going to fix anything. And then, of course, the last 2 years, the only thing anybody wanted was cash or a conventional. Somebody said that they would pay up to $50,000 over an appraised value. Right. But now we're back to reality. And sellers are like, I'll take anything.
Yeah, and the reality is I don't want anybody to make a judgment if they see a buyer make an offer on their home with an FHA, because even my 720 buyers right now are looking to FHA as a better option than conventional. Now, hear me out. Mortgage insurance with FHA never goes away. Okay, not unless you're putting 10% down and after 11 years. Otherwise, it doesn't go away. But let me tell you, they just dropped mortgage insurance in half based on what it was, a few months ago. So the amount you pay for mortgage insurance is half the amount it was, a year ago. When you compare that to what somebody will pay if they get a conventional loan, great credit, 760 credit score, and they're putting 3 to 5% down, okay? Versus FHA, they're going to get a government rate, FHA, they're going to get mortgage insurance way cheaper. Like, you compare the programs, compare the two programs side by side, you might be surprised to see that even with mortgage insurance, FHA might be the cheaper option monthly.
So D, where do you live?
I'm in the Houston area in Texas.
Okay, great.
We're looking pretty broad scope. I'm out here next to Travis. He's kind of been a beacon of light through all this. We appreciate him.
Travis is a good guy, man. He's a friend of mine. Yep, definitely. So when are you kind of digging in, prepared to wait for things to crash a little bit more? I mean, what are you expecting? I mean, what are you thinking?
I'm patient. The wife is not as patient. We've been renting for 12 years where we're at. We thought we were going to buy the house, but it seems like the landlord's changed their mind, or they've over leveraged it or something and can't sell it. So we started looking, and it was apparently the worst time in history to start looking. And we decided,
or it could be the best if you think about it. Like I said, being focused on what you're going to pay for the house versus a year ago. If we didn't look at the rates at all, and we just looked at how much you're going to pay for this house, I mean, they are cheaper than last year. That's good. It's just about equating how much cheaper it's going to be.
And somebody made the comment earlier about somebody saying 20% is not a crash, and I'm like, if you have a 100% increase, no, 20% is not a crash. It's
all relative. I mean, about every 10 years. I remember when my mom bought a home in 1985, right? And she bought it for $120, and then in 1995 she sold it for $120. You know what I mean? It was like, and then I remember in 2008 at the very, very bottom, what we sold this condo for, very, very bottom. And in 2018, the prices exceeded, the values exceeded where they were at the height in 0506. So it is circular. They do come around. I feel like as long as you understand the time frame of how long you're going to have to be okay with sitting there and living there. If you go into it going, I could stay 10 years, you will probably make it 7 okay and not be complaining too much. But anything past 7, man, you're not going to make it. If you say right off the bat, I can't live here more than 2 years, you're not going to make it 6 months.
And I think everything too is acknowledging that, and I'm kind of saying this because a lot of people are wondering, when the prices are going to crash. And Alisa, they're not less than a year ago in a lot of areas. I mean, there's still a huge amount of the country that in hot markets, prices are up.
Yeah.
And
they
from
really haven't
last
come
year.
down much. Yeah.
Yeah. And so, I mean, we're seeing up from last year. I'm not talking about coming down. I mean, we're talking about some markets are up, as high as 10, 15% in some markets.
Yeah.
And, so when we're looking at, it is so kind of broken, right?
Mm-hmm.
And a lot of it is, and I've said this from the beginning, I think and look, I mean, call it what you want. I've been in business for going on 34 years, self-employed. I've seen a lot of this up and down, right?
Mm-hmm.
I mean, I think that we have yet to see the tip of the iceberg of a recession.
Mm-hmm.
So we're talking about, rates. We're talking about home prices right now. We're talking about a lot of different things. What we're not talking about are some of the scariest things. You had mentioned in the beginning, this, AI that is going to take jobs away from people by the millions.
Mm-hmm.
I mean, think of the people that are in copywriting and advertising and marketing and things like, I mean, we're talking about, look, I'm not going to pay a advertising agency. I'm just going to use this chat, what is it? GDT? Is that what it is?
GPT.
What is it?
GoPro Tom.
All right. GoPro Tom. Right?
GPT. Yeah.
Right. So I'm taking out Tom, my chat bot, right? Guys, we are going to see so much happen in the next 5 years, right? We have yet to see the tip of this iceberg. We have had runaway inflation for 2 years that has so far outpaced wage growth. We just heard Jay Powell just announce in the last FOMC after the meeting in the briefing that wage growth is slowing, right? Wage growth.
Yeah.
Right. We're not talking about jacking up wages 9% over the next 365 days. We're talking about massive corporations, massive layoffs, and we're talking about home prices that I don't care who you are as a seller, you better be happy with your rate. Because I'm telling you right now, I know people that it's crickets. They have their house for sale and it is crickets.
Mm-hmm.
I know of one in particular. They overpriced their house by at least $400,000.
Yeah, that's insane.
Right? It's almost 1.5 million, and they will be lucky if they get 950. Okay, this is real life, right? So what I'm saying here is that it is hard to predict. We have to decide if we're going to be buying a home in this market. And I get it. Some of you want to do it. You're tired of renting. I get it all the time. I have people chat in, they email me, they're tired of renting.
Mm-hmm.
This is a lifestyle you're buying right now. It's a lifestyle. So, buy what you can afford. I love the fact that you're talking about, what'd you say, 21% DTI?
25%.
25.
Yeah.
25% DTI. That's fantastic because your bills are going to go up. You're going to repairs on the house. Life happens. Things change. Guys, make sure you have 6 months of cash in the bank to pay your bills if something changes. But what you're hearing, D say here is, he's driving used cars. He's renting right now. And you know what? They're still together. Him and his wife and their family. I mean, this is not the end all, man. He is, he's surviving, right? Renting a house. Big deal, guys. Don't get so stressed out about it, right? And, save your money where you can.
Being ready for the opportunity. You're doing the right thing it sounds to me like you're working on your credit score, maximizing your credit score during this time so that when the time goes, you're ready to go. Keeping credit card balances low.
Oh, yeah.
You got to be
about, Travis and his sort of wisdom he's helped provide. That really helped me dig my heels in, and I'm literally 3 times the cash flow now than I was when we started looking, because it made me think. Okay, I don't need this pack of cigarettes. I don't need this drink. I don't need this dinner, and it adds up.
Huge. It's all the things that add up. Yeah,
it's not that much of a tweaking either. Right. I mean, it's doable.
It's being aware. Yeah. I agree.
Well,
I just want to excuse me just for one moment, because I love how our viewers get to give some of their opinions too. And I thought this was very cool. Robert D, he's got a nice comment for you here. Bro, keep patient. If you are paying fair price on rent, no rush. Come fall, winter 2023, you will be able to make a decision with no regrets. Buy now, and you could regret it for life. So thank you for that.
Yeah, we appreciate you, man. God bless. Thanks for joining us.
Yeah, thank you for the sanity check. Y'all have a
man. We'll talk to you soon.
Bye.
That's great, man. I tell you what, I love that. I tell you, I mean, it's so nice to hear that, people are listening. People are listening. I mean,
well, they're communicating. I feel like we're conversating about it now more than we ever did. And that is part of it, is like, sometimes we don't even know what questions we don't know. We don't even know what we don't know. And so it's kind of like you have to get the conversation going and listen to other people conversate, so you get ideas of what you should know. You know what I'm saying? I listen to people all the time and go, well, that's probably, I wouldn't have known to ask what that is. I wouldn't have even known what that was, without having that conversation. So I like that piece. I think that we can really all help each other,
Let's
take some questions. Absolutely,
okay.
Listen. I agree.
So first we've got Travis. He wanted to we have so many here. I gotta scroll up. So we've got Travis here. Thank you so much for the super chat, Alisa.
Thanks, Travis. Appreciate
Thank you.
Buddy.
Have you noticed it's been more difficult to get AUS approval or any lending restrictions within the last few weeks? Great show. Thank you.
For sure. I mean, I see it tightening up all the time, but I know that, I was doing it a loan today for somebody and thinking about them wanting to get cash out of their house, and their credit scores weren't great. I mean, they're in that like 620, 640 range. So you got options here. You're going to go FHA. Okay. Then we're stuck at this loan limit of 550, and she owed like 500. I thought, gosh, that's only going to get her like 50,000 cash out of her house, but we could go up to 80% loan to value on FHA, where if I flipped her over to conventional, the rate, everything, when your credit score is not high, even if it is high, the rate, everything gets more expensive. So in the end, I mean, just kind of evaluating options and stuff, I felt that conventional would be the cheaper option to go. But once we ran it through the automated system, it wouldn't take it either way. So I was like, okay, back to the drawing board. And sometimes we do that. But yeah, I am seeing it tighten up. 100% credit profile is just as important. I see people getting their AUS approval jammed up because they're telling their clients to go and pay a charge off from years ago, a collection from years ago. That's not going to delete. It's just going to update that there was activity on a bad account. And even though they think that's what's going to make the score go up, maybe it goes up a couple points, but in the automated system, it reads it as you just had some activity with a bad account, and it denies it. So there's some strategy there, even with working within the loan systems, the automated systems. But yeah, definitely tightening up.
Alyssa, I'd like for you to tell the audience the difference between mortgage insurance premium that is sort of like a prepaid and a PMI.
Yeah. Well, so are you talking about like a lender paid mortgage insurance or something that the borrower can pay out of pocket? I'll be honest, unless your credit score is like at 800, 760 or higher, the borrower paid, lender paid options are not going to be good. But it's a great option. I can't tell you how many times I have somebody who wants to put 20% down. And I'm telling you right now, and this is going to continue this way, If you put 19% down and you have a good credit score, your interest rate's going to be about a quarter lower. The mortgage insurance on about a $400,000 loan, you'll write a check for about $2,000 and buy out the mortgage insurance for life. Now you got a rate that's quarter less, and maybe you came up with $1,000 less than the 20% down. So the reason why they give you a little bit of a better rate is because now the loan is going to carry some mortgage insurance, which alleviates the risk. Okay, if you default, the mortgage insurance pays off the loan. So it doesn't help you. But
just kind of dumb it down a little bit for people, though. I mean, people are seeing that there's a dip in interest rates. I'm seeing addendums that are coming across. I'm seeing finance addendums that don't even come close to what people are seeing as these advertised rates, right? I'm seeing higher rates. I'm seeing points. I'm seeing,
definitely.
Mortgage insurance premium as a prepaid on closing, right? I'm seeing people getting gouged here.
Oh no, that's not a gouge though. I want to make sure you understand that's not a gouge.
Well, explain.
That's them being creative, okay?
Explain it.
Taking prepaid mortgage insurance, FHA charges the upfront mortgage insurance premium. It's rolled into the loan. So it's part of your closing costs. It's not money you pay out of pocket. It's rolled into the loan. That's part of the premium of paying FHA. You'll put 3.5% down. It will look on the loan amount like you only put 1.25% down because they roll back in that premium. Then you also have a monthly mortgage insurance premium on FHA, but they're not gouging. Points are not gouging. Unfortunately, in the market we're in, banks know that you're going to refinance. Okay, they know it. As soon as the rates drop, you're going to refinance. So it's very hard for them to pay, to give you basically, if you didn't pay points, you're going to have maybe a higher rate. So maybe you're at 7.5 with no points, right? But if the borrower is like, no, I want a 7% rate because the payment's going to be this much cheaper, I'll go ahead and pay the points to buy it down to 7%, then that's not a price gouge. That's them buying the rate down. Is that a good idea?
How does it? So that's like a half a point, right? I mean, so you buy. I mean, so what? It's very expensive.
There's no exact amount. Yeah, there's no exact amount.
Very expensive.
It could be about 1% might buy your rate down an eighth or a quarter if you're at an $800,000 or $900,000 loan amount. You have to see if it makes sense. Yeah, sometimes it doesn't make sense, but I will tell you that most lenders can't. We can't just decide what we want to make like we used to in 2008. They stopped all that. So it was like one of those things where you have to determine at the rate, basically, what's the best your bank will offer with the rate and the points involved. Like, why would I not tell somebody to pay points if I could get them 6.99 if they paid a $400, a $400 discount point to get there versus, let's say the rate with no points was 7.5. Like the lender, there's a sweet spot when we're looking at the rates. And if the lender knows how to read the rate sheet, then they know how to go, hey, it's worth it to pay this extra $1,000 to get your rate here because it's a huge difference in what your payment would be, or it's not.
I had a lender had mentioned to me that he, I guess, is now working under a different manager or got to another level or whatever, and he's saying so now his pricing is better. How much, I guess, of a range can somebody get by shopping alone? I mean, so when you're looking at different lenders and things like that, I mean, and guys, I want to tell you, and I don't want to talk about commissions and specifics and things like that because, I mean, I want to stay away from that, but I want you guys to know out there, the audience, that things are negotiable to a certain point when you're dealing with service providers, right? Real estate brokers, real estate agents, right? No one should ever be telling you that this is the standard or this is the going or this is the average or this is the whatever. You have to be smart and do your own due diligence. I'm telling you that as a real estate broker, and I'm telling you that with, Alisa on our show. But I guess the question is, because people, here's the problem that I see. And, what happens is people, when they start buying a house, somebody's digging in to them,
Mhm.
right? I mean, they're talking about personal stuff. Oh my gosh, I was late on this. This happened
Getting
in my
all of
life,
it.
whatever. And I'm drudging it up. One thing that they don't want to do is have to do that a second time.
Oh yeah. Or
So
have
what
their
happens
credit
is-
ran several times by several people, right?
So what happens? People feel stuck.
Yeah.
Right? They're stuck. They start talking to a lender because the real estate agent told them to call them or whatever. And then next thing you know, because they didn't have a lender, and now all of a sudden, whammo, right? And I'm not saying that
Yeah.
good or bad. I'm just saying that, they don't want to be drudged up again, right?
Right.
But why is it that I see so much difference in rates
Yeah.
and closing cost and lender generated fees and things like why is there such a wide range?
And it's sad because at the end of the day, we all make about the same amount when it comes down to it. But you have broker channels, you have retail channels, okay? Brokers might get paid a lot more on a loan, and in which they're allowed to offer much lower interest rates and still make a normal commission, but then they also have to pay all their fees and the credit report fees and all these other fees out of it, that in the end of the day, it's about the same as what the retail people will make, right? But yeah, everybody kind of prices differently, but I will tell you, it's not something to where there's some lenders out there that they'll get paid more if they can offer you, a higher rate. When I'm looking at it, I'm looking at my bank. It's like a search engine with, 15 other corresponding banks that we work with. But at the end of the day, I make the same exact amount on every single loan. It's a flat fee based on the loan amount, not on the rate I give you. So if I charge points, discount, none of that makes me more money. Okay, that's why I started.
Not as the loan
scores.
officer, but
no.
What about the
bank behind
mortgage
me?
company?
Yeah, I mean,
the mortgage company.
Maybe some of them they all have different ways of, you can never just look at somebody's rate. Whenever somebody says to me,
exactly.
I got a 3. Okay, cool. But what were your fees? What were the points you paid to get to the 3? What were your total closing costs? Because they can hide a lot of those costs in there. What was your term? Like, you got to really compare apples to apples. It's just the same thing as any, it's easy to get kind of, but I see a lot of people that want to shop around. And let me give you a little tip, a little hack here. Go to MyFICO, MYFICO. It's the only place you can go. Only place, okay, to get mortgage industry specific credit scores, like the ones a lender would pull. Not the ones from Credit Karma or Chase or Amex or Capital One, any of the ones your banks are giving you. They're all free. That's not your scores. You go to MyFICO. You have to pay a $29 fee, but you get the real deal as if the mortgage lender pulled the scores today, but there's no inquiry. It's you pulling your own credit without the hard inquiry. Once you know your scores, okay, I could give you a set of maybe 5 questions that you could call 3 lenders and say, I have this score. It's my middle FICO out of FICO 5, 4, and 2. Then the lender knows that you're not just telling them your Credit Karma score. They can really realistically work with that. Then they'll ask you some questions about your income and your assets, the CIA, credit income assets, to determine what they would be willing to offer you. But I think it's kind of hard to go do the whole rigmarole with somebody, because these days, especially if you're a first-time home buyer, I would never be trying to shop around for rate. I would be shopping around for the right person to guide me. Okay, if the person's the right person, they're going to get you the best fair price, the best rate that's fair, that's competitive, but that's also, like I said, I'd rather always work with somebody who's fair than cheap when it comes to big things, And
so how do they know that? How do they know? I mean, so I hear so many different, depending on who you talk to, right? The lender. I mean, sometimes the bank says, oh, we can give the best, we have the best programs, right?
Mm-hmm.
I mean, you see like Wells Fargo now has stopped correspondent lending, right?
Mm-hmm.
Which is where they allow you to, write
Lend
their loan
their
or
money.
shop their loan. Right.
Yeah.
Right. Use their money.
Mm-hmm.
So they stopped that. Right.
Mm-hmm.
And so, but you hear people say like, oh, the bank's the best place to go. And then you have the people that say, no, you want a mortgage broker that can shop,
Mm-hmm.
different programs in different banks. I mean, what is the best?
I really think I've been a mortgage broker the first 10 years of my career, and the second 10 years I was a mortgage banker, not a depository bank, a mortgage banker. So kind of acting like we have the Wells Fargo line. We have all these banks, credit lines, warehouse lines to be able to lend out money, underwrite it in-house, use our own underwriter process to everybody, fund it with our money. And then after it closes, sell it back to the, Wells Fargo. They put the money back on our line, and here we go again. Brokers, in my opinion, and believe me, it's always a fight in the industry, brokers versus retail. But brokers are getting some good prices right now, but they're not. I don't feel like they're going to stay. I know you brokers watching me are like, but I don't think the prices are going to stay that low forever. My girlfriend just became a broker. She left a big bank, and she's, bragging every day about how great her rates are and how much lower they are, and she can beat out everybody. But then by the next month, she called and said, I just got the credit report fee for all the clients I ran credit on this month, and it's $2,800 that I have to write a check for right now. And rates are going up. I mean, that's how her mentality was, because she kind of runs her own shop. And so she decides, and if she goes out to her clients and offers what she can offer to make it make sense for her to stay open and things like that, and her clients feel that value is there, is there somebody who's always going to be a little bit cheaper? Yeah, you always get what you pay for. And I will tell you,
I don't know about that. I mean, you're getting a monthly payment for the next 30 years. So, I mean, I'm looking at that, right?
Yeah.
I mean, you get what you pay for, but you say goodbye to them.
Yeah,
and then they get
you do. But I think a good lender can be literally, irreplaceable. Kind of, there's a priceless person. Honestly, the right person who's like a good older sister who knows. Who would tell you stuff that you wouldn't have even known to know,
Yeah, that's
invaluable. Yeah, but that's hard to find.
And that's Alisa, by the way. We love Alisa. We're glad that she comes on with us. I like to challenge her a little bit. She's tough though, man. She can hold her own, and she does help a lot of people. And we're going to dive into what's happening with the banks. Is money going to tighten? Are lending practices or standards going to be increased? We're going to talk about the Treasury here in a minute. And, how that competes with mortgage-backed securities. And really, as a wrap of all of that, we saw where with the banks collapsing, the people being afraid of their money being safe, there was a panic there for a bit on the streets. It pumped billions and billions of dollars into the too big to fail banks. Bank of America, Wells Fargo, JP Morgan Chase. I mean, we're talking about big money that escaped regional banks. Regional banks have lenders that are writing mortgages. We're going to talk a little bit about that. But before we do, let's take some questions.
Just a reminder, guys, we are taking live questions tonight. So if you would like to, there's a link at the top of the chat here, and you can go ahead and click that to be brought into the show and ask your question. But I wanted to address this because Heidi had technical issues, but she did say there was a recording error with her hopping on the live stream. But I just want to ask your guest what kind of impact a HELOC has on your credit for buying a new home.
Very little. I mean, believe it or not, a lot of people use their HELOC for so that they don't have to carry credit card balances, that are going to really drop your credit score. Even though the HELOC is a line of credit, revolving credit line, it doesn't impact your credit score the same. So you might see a small decrease in your credit score when the HELOC first opens on your credit. But then if you use that HELOC to bring the credit card balances down to like $10, $20, and you wait for those statements to close and update, you're going to see a big boost in your score. So it's one of the number one things I talk about before buying a home. If you're within 6 months of wanting to buy or refinance or anything like that, to really get your credit card game in line, which means either getting a 401k loan to wipe out the credit card debt. You need something to bring the credit card balances down to about a $20 balance just to display financial discipline. your scores will shoot up. The mortgage industry specific scores will shoot up, and that will make you more eligible for low rates, for low everything for mortgages. That's kind of the little trickery to do beforehand. Or if you can get an installment loan, if you can go to Lending Club or Upstart or Freedom Plus or OneMain and get cash that then you take and pay the credit cards down to 20. Just don't do the 0% balance transfer crap that will put you, that'll keep you on a revolving train of keeping your credit scores really low, because the revolving accounts are what they're really, really measuring each month when the statement closes. Okay.
Well, the HELOC's going to get paid off, right?
The HELOC,
Impact
well,
the
not
HELOC
necessarily.
has on your credit for buying a home.
Oh, not necessarily. Maybe she's going to rent out her current primary that she got the HELOC on to have the funds to use for the new house. You know?
Yeah, maybe.
Yeah.
Yep.
But you got to get creative. If you are trying to boost your score in order to be able to get a HELOC, that you have to have a 680 typically for, or if you're trying to boost your score just to do like a cash out refi, you want to try to get your scores as high as possible for either of those options. And so the key is the credit cards. Get those.
What happens when you have one borrower that has an 800 score or better, and then you have one that has a 700 or 730 or something? So, I mean, do they come up with an average or
no? Lower. So I just had somebody who has a 589 and her husband's an 800. The problem is the husband and the wife make 50-50 income. So if we need the income for qualifying, we got to have them both on the loan. Now, if the spouse who has the lower score doesn't work, doesn't really add much to the picture, obviously we could take them off the loan, have them just be on title, and we'll go with the higher. But yeah, that's a crusher. Is sometimes you get somebody who's only following Experian, let's say, and they're like, I just checked my wife's scores and she's at 720 and I'm at 720 and it's going to be great. And then I go in and run all three of the FICOs for a mortgage, and it turns out to be 720, 700, and the wife's middle score is like a 660. So collectively, they have a 660, not a 720. That's a huge difference.
Yeah. And that's a big difference in rate.
Huge. Mortgage insurance too. If they're not putting 20% down, credit score is going to play a massive role. I'm talking, you got to usually be at that 680 or higher to even kind of get a conventional loan done with low down payment. But you can even be at a 720, and it's going to behoove you, or it's going to be worth it for you to push to try to get the 780 or 800, because it is cheaper for credit and for the interest rate and for the mortgage insurance.
Yeah. Can you use both borrowers' income and just not
but they still take the lower. Yeah. No. There are some loan programs that'll let you have that deadbeat boyfriend who's just hanging out on the couch every night. It's called border income. Like if you have a record of every month, he gives you $500 and you put it into your account, and he's going to sign something saying he's going to move with you to the new property. And that $500 does not exceed 30% of your total income, you can use it. But you got to document that. So tell him to write you a check. Take the deadbeat
boyfriend to the new property. Oh my gosh, we got bigger issues to talk about.
Hey, if you can't qualify, if you make $45,000 a year and you're like, how am I ever going to buy in Arizona? You're going to get your kids who still live with you to start paying you monthly. And you're going to start documenting it, and then they're moving with you, and then now or you're getting your kid on your credit card. What
happens when they move out, Alisa?
Then we rent out one of the rooms to the maintenance guy, to the neighbor.
Gosh, that sounds like trouble.
Golden
Girls.
Like trouble. We could move in like Jack Tripper, saying this week, Three's Company. We can move in together. That sounds like
disaster. One of the things that I wanted to talk about, and I know, you've never been a real estate agent, right?
No
right,
desire.
so you've never walked through the houses that have been foreclosed.
I was married to one. I was married to one for
one of the interesting things, in going through the 2008 crash, I had the experience of visiting a lot of properties that were foreclosed on. And, and this is my problem with the 40-year mortgage. If someone hasn't been paying their mortgage payment and they've been in default, they haven't been fixing things either.
Mm-mm.
And, you know, when you get an FHA loan, they do something that is a little different than a conventional when it comes to an inspection or an appraisal, right? The appraiser comes through and he checks things like, does it leak in the house?
Health
Right?
and
Is
safety.
the roof good? All the safety stuff, right? Well, what happens when they recast these mortgages? Are they going to reinspect the houses?
I don't see that. I see them doing some sort of a drive-by appraisal. I don't know what the specific requirement is, but something to like, we're just going to, yeah, exactly. But we're going to just see that the property's still physically there.
Yep. Still a house.
That's what we hope for. Is that waiver. Like, oh gosh, what condition is your property in? Yeah. They sometimes it's beat up a little bit. I know. And the other thing is, thinking of the people that are buying a little insurance. If you are buying right now and you're kind of like, should I go FHA? Should I go conventional? It's about the same. Here's one bonus is that let's say next year, the rates drop down to 5 and you were locked in at 6.5. Okay. But let's say what happens is your house that you bought for 400 next year is worth 300. Then how do you get that interest rate if the value's dropped, right? But FHA has the one good quality. Yeah, they'll let you refinance without that appraisal.
We're not refinancing. Rates are going up.
You just believe there's never going to be a 4 ever.
Rates are going up. Let me tell you.
How high do you think they'll get?
Realtor.com just published one of their economists just published that rates are going up.
How much higher?
There's all kinds of polls. I mean, we're going to be in the 8s next year. In my opinion, I think we're not going back. Look, over the last 50, 60 years, the average rate's been 7.7% on a 30-year fixed rate mortgage. If you look at the chart, ever since the beginning of time, we have seen the lowest. It has been the biggest mistake the Fed has ever made. Maybe they just haven't admitted it yet. Right. Mm-hmm. But look, let me tell you something. A lot of things happen. There we go. There's your Fred chart, guys. Right. Look at that. That's a 30-year fixed rate mortgage. All right. Oh, it's going back up again. But here's the thing. We got to think about something. When the rates go down, the prices go up. Let's stimulate it. Hey, when you look over time before the recessions or, after the recession, actually, the rates drop down. Well, why? Because that's how they get us out of the recession. Hey, we're getting ready to go in a recession. Let's drop the rates and stimulate spending. What happens when that goes on, right? I mean, hey, taxes go up, property taxes go up, transfer recordation fees go up. Everybody gets to make, well, not everybody, but look, this runaway train, if they ever talk about making a 4% interest rate again, I don't know. I mean, right now you can't afford, many people can't afford a house. I talk to people every day. They are professionals. They went to college. They have professional jobs making $50,000, $60,000, $70,000 a year. They can't buy a house. If they're by themselves, they can't buy the house. They need 2 incomes to buy a house, a median price house in the city where they work. It's unsustainable. We know rents are coming down. The pressures on the landlords. We got an awesome video. It's going to post tomorrow, guys. You need to watch it. If you're listening, you should check it out. Landlords are in trouble. If you aren't listening to what I'm saying right now, let me tell you something. If you bought a house to rent in the last couple of years, wow. We got all kinds of things going on. There's rent controls happening. I mean, there's accessory dwelling units that are going to be popping up all over America. Everybody's going to be a landlord. They're going to be renting their garage. There are more multifamily. There is a glut of multifamily. I was talking to somebody today. They said, I'm trying to find a new apartment. I'm paying $18.90 a month now. I went to this apartment complex and they just so happen to have one that I need. And they only have one. And today only, over the next 24 hours, they can lock it in for $1,700. But they've rented so many of them, guys, that tomorrow or the next day it's going to go up a couple $100 a month. Get up and walk out.
Mhm.
That is crap, right? Guys, we got issues. We got affordability issues.
Big time.
That's a
Gotta get
lot.
rid of-
That's a lot of work up here at 9 o'clock on Eastern time. And I'm tired. Just think of how I was at 9 o'clock this morning. 12 hours ago. Melissa could tell you.
It's high intensity a lot of the
We
day.
won't start with that because today's been the day, guys. Today's been the day that I've dealt with a lot of agents on the other side of transactions. And I could tell you, today is not the day. But anyway.
Let's talk about, because we have brought up foreclosures, and I think this is a good question for you, Alisa. Phantom, thank you for your question. Can you use a residential mortgage with a foreclosure property, like a 30-year mortgage from a lender or a 30-year FHA?
Yeah. It doesn't, you can, I get this question actually a lot. You can buy a house that's a foreclosure, meaning that the bank is the seller. The bank owns it. You know, you can also do a short sale. You can make an offer on a short sale. That means that there's really a seller who still owns the property, but they're negotiating with the bank, and based on your offer, what they're willing to take to sell that house. They're going to take a short amount. So that seller is going to have to walk away. But there's nothing wrong with the financing of those properties. It's just that a lot of foreclosures come as is. Okay, technically, like the banks will say that they're not making repairs or they're not doing. Look, at the end of the day, if there's repairs that are going to happen based on an appraiser going out there, or just a health or safety condition, a broken window, they're going to fix those things. But for the most part, that's the only thing I see, is that sometimes the condition of the property can be a little bit more rough, but doesn't change anything with your, it's not a special program that you have to go on. It's any 30-year fixed, or any year term.
And I want to, just what you were saying, Alisa, I want to talk about a couple things because, I'm seeing already short sales starting to hit the market. And, very interesting here in Maryland, starting to see.
I think you want to look at how, they say about 50% of all the homeowners in the U.S. have 50% or more equity. One thing we didn't have this last 10 years, were all of the loan programs that didn't prove you had the ability to repay. So, 10 years ago when this crash was going on, 12 years ago, and I looked down the street of my house, my cul-de-sac, if I said to my neighbor, I can't afford this, I don't want to have a house I'm upside down on, I'm walking, all six of them on the street would say, is there any consequences? No, because we live in Arizona. There's no. Okay, well, me too. Nowadays, if I did that, 4 out of the 6 houses on my street, their houses are paid off. They're not walking away. Okay, a couple of the other ones, they got a 3% rate. They're not letting go of that for anything.
Unless they lose their job and can't pay their mortgage.
And then there would be 1 or 2 that would literally fall into the hype, which is, I feel, honest to God,
unless they bought too much house and they were living month to month and they didn't have any cash like they were allowed to do when they were financing their house.
Right.
And they had less than $5,000 in their bank account and they realized that their house needed work. And then they're in a situation where they can't make their mortgage payment. Maybe that's why FHA has acknowledged that there's probably so many of these people that they need to extend their mortgage to 40 years. They're not encouraging them to sell and take their equity and reposition themselves in the market somewhere.
Right.
But the issue that I have here that we got to talk about is, guys, what Alisa just said about repairs. If you're looking at a house that needs repairs, the seller may not be able to make it.
Mm-hmm.
They may not be able to make the repairs. So you're in a situation, a lot of people don't realize, unless you're talking about peeling paint on the outside of a house and it's 30 degrees outside, where they will give you a waiver and allow you to escrow money and paint it when it's a good time to do so. These repairs have to get done before you close, unless you do a renovation loan, which is next to impossible.
Mm-hmm.
But, so that's the issue is we're starting to see where these sellers are like, I need to sell my house. But hey, guys, I've already dropped my price 3 times. And if I drop it anymore, I'm in a short sale position. I just talked to an agent that my client was interested in buying the house. And I talked to him a month ago and they said, oh yeah, well, we've dropped the price and we're trying to get a short sale. They have took the equity out of the house. They have two loans
That's
on
what
the
I was gonna
house,
say.
two
Yep.
mortgages. And you're saying they have tons of equity, but these people are taking it out.
Mm-hmm.
They are
People are
sucking
living
them,
on credit. Yeah,
they're
they are.
sucking the money out. So they're not as in an equity position as one may think, right? They got the second loan, the HELOC, whatever. They took it all the way to the max. Now their HELOC is an adjustable rate loan. That's gone up. Now they can't make that payment, right? This is real life, guys.
This is
just the tip of the iceberg. I just talked to the agent and I said, oh yeah, my client may want to circle back around and take a look at that house. Where are you in the short sale? She said, oh, as a matter of fact, she just moved out. She turned the keys in.
So she foreclosed.
She said, see ya. And I said to the agent, oh, that's so bad. I'm sorry. You know, it's terrible. My gosh, is she homeless? Does she have a place? She's like, oh, no. She's got another place to go. She's got a rental. It's a lot less. And she said to me, you know what? It's her own fault. She took all the equity out of the house and spent it.
Yep.
Spent it.
That's what I'm seeing too. Yep.
So, you know, we could kick the can down the road. We could talk about how all these people have equity in them. A lot of people have spending problems and they outlive they live beyond their means.
Right.
And there's no consequences. We're going to bail them out. We're going to help them out. We're going to rewrite this. We can't let them lose their house. We can't, at some point, you know, we are where we are. Let's take some more questions.
I'm going to segue into this one because Alisa, I want to hear what you have to say here. We've got Kenny. Any thoughts on getting access to the rental property equity without refinancing? HELOC, maybe, if any bank still supported? What do you have to say about that?
There's some banks out there that are doing it, but not that many. I'm seeing, yes, of course, the HELOC on a primary residence, but I'm not seeing that many that are willing to do it. So you might end up having to do. I did close 2 this month for 2 different realtors who owned investment properties free and clear, and their income has been declining over the last couple of years. And so we did a DSCR loan, and I do those in every single state. What we do is basically, I was able to get her cash out of the property for about, I think she was at about 60% of what it appraised for was what the new loan amount was. But we're using not her income. You use what you can rent the property for based on what the house payment is going to be. And as long as it doesn't exceed what you could rent it for, then they'll do the loan. So the rate is not that bad.
We look, and there's a lot of people. Look, I've invested in real estate for 25 plus years. And, I can tell you one thing, a lot of these, suck the equity out, stick it in your pocket, tax free, buy your next one, yada, 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 yada. Let me tell you, these commercial loans they're maturing. People were financing at 4%, 4.5% commercial loans. If you are a landlord and you have commercial loans, I'm talking about where you have 5 or 10-year lock-ins and the balloon payment, and they amortize it over 20 or 25 years, you're in for a rude awakening here. And whenever your loan comes up and, everybody's experiencing higher cost, repair costs are through the roof, insurance is up, taxes are up. Tenants have been, whacking these landlords by not paying them, being slow, causing them $10,000, $15,000 to do turnovers on the apartments. And these people have been taking their equity, sucking it out. And, man, this is a recipe for disaster. Everything is good when things are going up, guys. When things are worth more tomorrow than they are today, life is good. We are going to see a downturn. It is going, I see it. I mean, this is only my opinion. But when things are going down, when you've taken your maximum equity out and you are stuck, this is what other real estate investors are waiting in line for. They're waiting for the turnover, right? And, and a lot of these people haven't seen it come down. They don't know what it's like. I was buying properties for $40,000 in the county, in great areas, 40 grand. The people moved out because, I mean, they finally foreclosed, raining inside, whatever, right? This is, you know, a lot of these investors, man, I'll tell you what, I hope the same people that helped you get in business by telling you to cash out, take all your money and move on, move on, move on. I hope they have a good plan for you to help you decide, you know, how you're going to get yourself out of it. I would not take the equity out. You should, if you are a real estate investor, you should have 25, 30% equity in your property, period, in my opinion. You should be prepared for downturn, be prepared to put money, capital improvements into your property, and the rent's better. I've watched it. Back in the day, we were talking, I want 12% caps. You call up, you're a real estate investor, you call up a real estate agent or somebody and tell them you want a 10% cap rate, they're going to laugh at you. In most of the country, we're seeing that go down to 6.5% cap rate, not 12% cap rate. Right? We're seeing that reduced lower than I've ever seen. Apartment buyers, man, these guys, these operators buying up apartments, getting investors, you know, like, hey, rah, let's go. We're going to improve these apartments. We're going to take them from being $1,700 a month to $2,200 a month. And we're going to make things happen. We're going to renovate them all. Things are going to be great. We'll see. I could be wrong. Alisa, you look like I just shocked you or something.
I'm shocked. I'm reading shocked by the comments, dude. I am shocked.
The comments.
I've been on TikTok now for a few years, and no one's ever been that freaking mean to me, even on TikTok with kids. But
are you getting comments, mean comments?
No, I gotta ask Slug and Cameron, dude, what did I do? What did I do to you guys? Like, my word. I'm reading these going, jeez. I mean, like I'm like the fairy over here or something.
They love loan officers as much as they like real estate agents, okay? So I'll just,
how could it not be personal?
On that same boat.
Huh? The guy says, it's not personal, it's not mean. But how can you say it's not personal? Anyway, crazy people. I don't understand why you want to project people, you know, trying to help each other out, have a conversation. But man, it's that's not cool. But anyway,
let's talk about mortgage-backed securities.
Can we go talk about something else?
What do you want to talk about? You know,
I'm just kidding. No, I don't. Actually, I do want to talk about credit cards because it is one of those things where every single day it seems like we're seeing something that says, you know, now we're back up to over $1 trillion in credit card debt. The average person was like at $5,500 last year. Now it's like $5,900 in what they owe. But when you look at it, I was looking back, and 2007 was the first year that we actually hit $1 trillion in credit card debt. From 1968, you know, we kind of started moving up this track up to $1 trillion. But from 2007 to now, it's just been like this. It's been like trillion, 900, 800, 900, you know. So what happened was we were at about 6,000 going into the pandemic in credit card debt. And we brought it down to about 5,300, like in 2020, 2021. And we're back up to like, you know, 57, 5,900 on average. And you also saw the savings rates just go down, crash and burn. So I do feel that DoorDash, I think that's what I see mostly is like the food and the DoorDash is what I hear more than anything else from people I consult, you know, that say that's their problem. It's food. It's DoorDash. It's those conveniences that are eating up the money every day.
Do you think now you just said something, and I've said this for weeks, right? Because I didn't realize. Look, when I watched SVB go down the tubes, right? I mean, what a shocker! And I know friends that have tech businesses, and they were. I mean, it was probably the worst weekend of their life. Right. I mean, they were freaked out. But then when I saw, you know, everybody panic and some bank runs and then the big transfer to the big banks from the regional banks, you know, one of the things that made me think about this, I said, you know, I didn't even think about it. But we went from the highest savings at the pandemic, right? When the stimulus checks were going out. I mean, you see it, you saw it. Listen, people had savings accounts were through the roof, right? They were. Mm-hmm. So we went from the highest savings to the lowest savings in history, right? Mm-hmm. I mean, boom, everybody lost it. Think about, I heard something where the banks only keep like 10% of the depositors' money. Mm-hmm. They invest all the 90%. Maybe I'm wrong on the exact, but it's a lot, right? I mean, you guys can Google it, right? Mm-hmm. But if you think about this, people were pumping their money in the banks. The banks were like, oh, this is great, man. We've got so much money in deposits. Our depositors are rich. We had all this PPP from businesses that were like, yeah, man, I got $5 million PPP. I'm putting it in a bank, right? I'm going to pay my bills with it. All these banks are like flush with cash. And then over the last 2 years, it's been sucked away from everybody. And all of a sudden the banks are like, wait a minute, you want your money back? Well, we don't have that today. Right. We don't have your money today because we actually only kept 10% of it. And because we had so much cash, we invested it all. And now we got to liquidate our assets. Mm-hmm. We got to sell off our bonds, right? We got to take a loss on it. I can only imagine. I mean, we've already talked about adding, so much money back to our balance sheet. They just said that we gave back half of what we've reduced our balance sheet by. We've already given it back in the last couple of weeks, right? I think it was $4 trillion we made available to banks to get money to protect depositors' accounts and help banks pay their bills. If you give me money and I only keep 10% of it and I invest the rest of it, sounds like good business to me, huh?
Yeah.
That might be one of the reasons why the banks are having a hard time, guys.
Yeah.
Let's talk about the credit crunch. No wonder they don't have money to lend. Sounds to me like they're probably struggling.
Mm-hmm. Banks have been fighting for our deposits for a while. I mean, think about all the bank bonuses and everything that was going, there was a lot more competition than there ever was. And I find it interesting that all of a sudden, now everybody's back to the main five where everybody was, going over here to Chime and going over here to this credit and spreading out, where they were getting the most APY.
I go to the bank now and I say, hey, is John around? Oh, John, no, he retired. How about Mary? Is Mary there? Oh, no, Mary no longer works here. Does anybody work here anymore? In fact, I mean, I roll up to the drive-thru and I'm like, hello.
Yeah.
Hello. Oh, I'm sorry. Oh, okay, I'll be right with you. I'm waiting on. I don't know who you're waiting on, but who's waiting on me? I don't know. I've watched this happen now. Are they going to stop lending money?
No.
Are they going to raise requirements to get a mortgage?
Maybe. It's definitely going to keep being expensive, Maybe they're going to raise some more requirements, it's not really as much of the requirements. They're not going to be increasing the credit score requirement yet. I don't see that happening, but I do see the internal switch, the internal automated underwriting engines getting a lot tighter.
Is FHA going to be our landlord?
Yeah, I do believe it. For up to those, I mean, in Arizona, it only goes to 530.
Was it maybe? Yeah.
Yeah. It's not even like I thought. I had to think about it. I really do think
that might be the
FHA
plan.
Is going to be the main loan program, and the landlord. Yes, I do.
Yeah, I think that's the plan. We're going to cut back on mortgage-backed securities, but we're going to be the landlord for America.
Should be fun.
I
think there'll be more people. I think the co-ownership, the multifamily, the friends buying a house together because they can get, a house that's affordable. When you think about it, if it was you and your best friend and, you didn't want to have to spend more than $1,500 a month on a house payment, but you couldn't afford anything in California. There wasn't any houses available for $300. Okay. But maybe you could find a small duplex for $600,000. Right. And they could be in one side and you could be in the other. So you guys split the down payment, you split what the purchase, what the monthly payment is, and you're probably closer to like, $1,200 or $1,300 a month. But I just think that we have to get more creative with how to do it.
Yeah.
Maybe I saw a lot of properties lately that have one unit in the front and one unit, in the back that, you can have that property be making part of the rent payment. California just came out with a program this week that basically they're giving up to $100,000. They're going to give you this down payment to help you get into this new price bracket, right? And then the payback is that when you go to sell the house eventually, you have to pay them 20% of the equity in the future.
Cool.
So I don't think I'm ready to sign up for that one.
Oh, I like that. And you know what else they came up with? And matter of fact, John Williams, he's great. He moved from California. He lives in Florida now, but he helps people with real estate investing and, just good business coach too. I podcasted with him already. We're releasing it tomorrow. It's going to be fire. The last podcast I did with him, we had over 300,000 views. I mean, this guy's got the numbers down, man. You want to talk about somebody that can rattle off numbers. He knows his stuff. He was just telling me that California, and by the way, I think LA still has a eviction moratorium till they just keep pushing it. Some of these landlords haven't been paid in 3 or 4 years, in at least 3 years, maybe exaggerating by 4, but great show being released tomorrow. But my point is, California just came out with like a mansion tax or something crazy.
Yeah, it is.
Did
That's
you hear
why
about
everybody
that?
was selling it. It's what it is it's between 5 and 10 million. You're paying. God, what's the number though? I just did the numbers the other day. Yeah.
Is it 4% right there?
4%. Yeah. Anything over 10, you're paying 5.5. So we saw like Marky Wahlberg. He ended up selling for like 55 million. An investment he made, I think 10 million initially, the investment on. But somebody just lost their butt.
So,
Britney Spears, maybe.
What they're going to do here, guys, is they're doing this. I think, according to the article, a lot of this is going to go to the homelessness situation they have. A lot of people are homeless in California. They're not going to do anything about reducing the cost of anything. What they're going to do is they're just going to, when you sell your house or your business building, they're going to charge you 4% and up to 10 million, or I think it goes up from there. And that is a cost I don't think you can defer. Like a lot of these investors sell their business or their buildings and they, put them in a 1031 tax exchange. I think that this is exempt of that. This is just a money grab. And I'm sure they got a great reason to do it. I hope it doesn't come over to the East Coast, but I think, like you said, I mean, everybody's going to have an accessory dwelling unit at their house because they're going to need it to make ends meet. Yeah. And the way it used to be was an in-law suite. It had to be a blood relative, right? In order to stay in your house, in order to have another kitchen in your house, another entrance or whatever with a kitchen, an apartment. And now they're going to make these accessory dwelling units. And I think for the most part, what I've seen in legislation is that you have to be an owner occupant. So you can't be an investor and be like, oh, I'm going to buy this house and I'm going to put an apartment in the back or turn a garage. I think it has to be an owner occupied dwelling. But anyway, let's take a couple more questions. Well, listen, don't worry about these. Don't change your great personality because some comments.
They got me down a little bit. I'm okay.
No, yeah, come on. Let's snap out of that. We got bigger fish to fry here, man. We're trying to solve.
I'm just like, look, I'm a lover, not a fighter. I don't want to be misunderstood.
We got to solve these housing issues. We got work to do. We got people to educate. We got to let these people know what's going on. What do we got?
So we're just going to just do a couple of these comments here. Local. I always like to hear what's going on locally for people. We've got Isaac right now in our area, California, 20 miles north of Sacramento. Lennar has new homes with 4.5% fixed rate, free solar, washer and dryer, fridge, and other upgrades. We went back after 2 weeks and all the homes are gone.
When they buy those, the mortgage packages like in big chunks, you know. They lock in on a rate so that they can offer something that nobody else can. And yeah, those go really fast.
Mm-hmm.
Gosh, 2 weeks, he said. Yeah, 2 weeks.
Yeah, 2 weeks. And then we had MH08. My property taxes in Denver have tripled over the past few years.
That's something
that's
closely,
a big bill.
Yeah, to look at. Arizona, a lot of our property taxes went down because we have rules in place that don't let it exceed up more than 5% a year. And so a lot of us on the actual tax values, I mean, we actually saw a little bit of a drop. But yeah, that's something else to pay attention to when you're looking at, you know, I'm going to move to this state. Well, then what if you find out that maybe you're diabetic and you move to that state because the taxes are cheaper and everything else is cheaper, but you find out that the $100 a month that your old state used to charge you for insulin, you know, isn't that way in this state. This state doesn't have a cap. And so you're spending $1,200 on insulin every month. I mean, it's a completely different, that's a pretty big thing. You really got to know thyself. You know what I mean? When it comes to moving to another state or thinking that the grass is going to be greener, because sometimes it's a lot more expensive. We just don't see it, you know?
Mm-hmm.
Yeah, we were talking about that before the show, you know?
Yeah.
I mean, some places don't have state income tax, but they charge you for everything, right?
Sales tax is crazy.
I mean, there's all kinds of pros and cons in, you know.
What would you
about
say in
everywhere.
Maryland, though? Give me one pro and one con of if I was like, I'm in Arizona, should I move to Maryland or should I not?
Right. So I'll tell you one. I mean, you get to come and visit Melissa and me
Oh, yeah.
and Joe. Joe's behind the scenes. I mean, that
neighbors.
is a pro. I mean, that's a pro, right? That's
Good
not
neighbors.
a con. That's a pro.
That's a good one.
You get to come and see us.
I got friends.
You know, I tell you, it's a great question. Maryland, I love Maryland. It's a great state. Okay. I'm not always happy with the decisions that are made. You know, but I mean, I like the state overall. It's beautiful. You know, we have one of the benefits is that within a 3.5, 4 hour drive time, you can be from the mountains to the beach. And, you know, we have lakes, we have farms, we have, you know, the Eastern Shore, we have crabs, we have, you know, blue crabs and you know, it's great. You know, a con would be, you know, we got some serious traffic. I mean, if you're driving, we have two main beltways. We have 495 and 695. You know, the DC beltway, 495. Man, I tell you what, I have a, you know, sort of like a 10 to 2 rule. I try and stay off of it before 10 and after 2, because you get stuck and you are really, you know, you're screwed. But, you know, yeah, come to Maryland.
That I-95, the thing that happened a couple of years ago where people got stuck out there for like hours and I was this close to wanting to move to Maryland, and then that happened, and I'm like, okay, no, we're not doing that now. You know, I don't know.
I don't think that was in Maryland though.
Okay, 95 was in Virginia.
Yeah, it was in Virginia. Yeah,
Virginia.
Yeah,
Right.
and to all the people that have, you know, EVs, I mean, that were stuck, and that's don't get me started on this one, man. I tell you what, you will get me over the top. Yeah, I mean, we have bad weather. Okay, if you get stranded on the road, turn off your battery operated car because you're gonna freeze once it, you know, you can't start it up and warm yourself up. And you know, and I know a lot of people that were towed. We have a lot of electronic vehicles,
really,
and you know, a lot of Teslas. And I know people that were on 95 in Virginia, and they were screwed, you know, stuck in traffic, had to get their cars towed. I mean, it was bad.
Yeah.
But yeah, I mean,
That's
yeah. We didn't get any snow this year. Surprisingly enough, I don't remember too many winters where we basically got nothing where I am.
I didn't know that was possible.
Mountains.
I thought you guys had quite a bit of snow. So none? Like zero?
None. Nothing.
Not this year. No.
Wow.
Ski resorts are hurting.
Yeah.
Wow. Okay.
Making snow's expensive.
Yeah.
Let's take 2 more.
Okay.
I know we could stay here all night, and I know Alyssa. Look, the comments are saying they love you. And
they do.
Yes. Hey, look, man. People tell me I don't know what I'm talking about all the time. Get used to it.
We get it too, Alyssa. I mean, I've had comments. You know. It's just, you know, what are you gonna do?
You know, I expect it from certain, like I said, like TikTok. You expect it, you're waiting for it, but not really Facebook. I don't see very much. But like, I don't get that from Facebook ever. But I wasn't, especially people don't know you. So I just was like, I was reading a comment, and then I read a comment that said, actually, she's reading these. I think, how can you be that mean? You know, I don't know, but whatever. We're moving on from
Jordan Bressler. We love you.
Okay, thank you, Jordan. I love you too.
I think
I'm
she's
a lover.
great.
I promise you.
The energy and personality are amazing.
Thank you. I appreciate it. Can you tell Leo that I need validation? God bless it. Anyway, I'm not here to fight.
I get somebody that calls me every week to the office to tell me what I said that wasn't right.
Oh, really?
Oh, yeah.
Wow. Well, what can you do, Todd? Because you're like celebrity show. You got a massive following, you know?
You know, I don't, you know, it's like, guys, I don't have a crystal ball. I mean,
just best guess,
anyway.
You know?
All right.
Mm-hmm.
2 more questions.
Yes. So
It's
we had
late.
multiple people, and we've got Market Mania here. So hi, Luke. Thank you for the question. But is credit tightening right now? Hearing rumblings, it is. And there were quite a few questions asking the same thing.
Yeah.
And before you answer, this is Luke. We just podcasted with Luke. He has a YouTube channel. Big shout out to him. Market Mania. Check him out. Subscribe. He is in Canada. We've got a couple friends of ours that are in Canada. And, you know, I have a couple, you know, real estate brokers that are in Canada. And we talk all the time. Some of the most expensive real estate on the planet in Canada.
Yeah.
And, but yeah, thanks, Luke.
Yeah, credit's definitely tightening. I mean, you're going to start seeing a lot of your credit cards. A lot of people were frustrated that they were working on their credit in the last couple of years, and yet they said, "Why is my interest rate on my credit card keep going up?" I'm like, doesn't have anything to do with you. It has to do with the fact that when the feds get out there and talk about raising rates, what it really is going to be tied to is what you're going to see. You're going to pay as a credit card interest rate, APR. The HELOCs. And so credit card, the interest, average interest is like 20% right now. So if you think about that, 20%, if somebody owes, you know, $5,000 in credit card debt, their minimum payment is usually based on 2% of the balance. Okay. So 2% of the balance, $5,000, that's $100 in payment, right? If the interest is 20%, okay, then you have to think about right off the bat, how much of that monthly minimum interest payment you're making is going to interest, and realize that very, very little, like 10, 20 bucks is going towards actually reducing the payment. But if that rate goes up anymore, let's say the rate goes up to 24%, that minimum payment you're making isn't even making the minimum interest owed for you to be in debt another month.
You're negative.
So now you get tacked on, and now your credit card balance is growing, and you have nothing to say for that. You didn't even get to go out and to have a nice dinner. You made a payment, and it still went up because you're not even making the rent-a-debt fee every month to be in debt. So you got to think about what's the minimum, just rent. I mean, just the interest I have to pay to be in debt, to wake up and be in debt this month. Because if you're anything over and beyond that amount is actually, you know, the amount that's actually going to be reducing what you owe next month, as long as you don't spend any more between now and then. So, yeah, I think what you're going to see is a lot of credit cards for no good reason suddenly lowering your limit. Suddenly seeing that you opened up a credit card and that it's maxed out and nothing's really changed. It just
then they're going to get you for over the limit fee.
Yeah. Over the
They're
limit fee.
You owe 10 grand.
You could be just like $10 over the credit card limit on the day your statement closes. And if that's what reports to your credit, even one credit card above that 100% it's usually a good 10, 20, you know, points in your credit score. That you could just drop it, you know, just increase it by just getting the balance just below the limit. But yeah, you got to really pay attention to the statement dates, like I said.
What are we going to see? And we'll take one more after this. And we thank you again, Luke. Let's talk about mortgage-backed securities and the 10-year treasury.
Mm-hmm.
Can you speak to that at all and how they compete with one another and just
that's probably not going to be my plus, like is to be going into analytic talk. I don't want to say something and then be called out and look like a loser. But what I do want to say is I don't care. I follow Logan, Barry Habib, you know, huge housing analysts that, you know, have mostly got it right and a little bit got it wrong and have not, you know, it's a hard thing to predict really what's going on right now. So I don't want to speak and not speak prophetically. We got a highbrow audience here, so.
Yeah, well, I
But
just
we'll
think
see
it's
what
interesting
happens.
because I mean, you're dealing with, right? When you're dealing with the Treasury, you're dealing with government, a pretty much a guarantee interest return on your money.
Mhm.
So, I think what happens is a lot of times when we start to see shaky ground with mortgages and we start to see the Treasury, the 10-year Treasury, get
out.
up and really compete with the mortgage-backed security. It's like, why would I invest in a mortgage-backed security when I can invest in, a 10-year Treasury, right? That is going to, give me a safer, kind of guarantee on my money, right? So what happens is mortgage rates have to go up. If I'm going to invest in a mortgage, I'm going to have to pay more. And look, I'm not an expert at this either. It's just, I've listened to the same people that you do, Alyssa, but I think it's interesting how, we watched, the Treasury, the 10-year drop. And, now we're seeing it start to go back up again. I think, we're going to see the government needs money.
Maybe.
They need cash. They're either going to start printing it or offering people more money.
I don't see that, but I do see that they're just continuing to be. I tell you, hype in America. I understand why they want to get rid of some social media stuff because hype will do some damage.
Get rid of social media stuff. You mean they might get rid of
TikTok
Sachs
and stuff.
Realty
The restrict bill. The restrict bill.
You think
the bill they're looking to restrict a lot of stuff.
You think they'll restrict us?
Yeah.
I think they're going to restrict.
They're going to restrict you, Todd.
I tell you, I've thought that some of my videos maybe didn't get the viewership that I thought they. I don't know. I don't think they would do that. I don't think they would do that to us. I don't think they would cut us back. Trying to educate people and be a good, strong, foundation platform where people can talk and share their thoughts back and forth, good and bad.
Well, people get nervous about their data being stolen or taken, right? But here's the thing. One little rant I have to say is, look, there are 3 companies in America, Experian, Equifax, and TransUnion, that literally make billions off selling your data. You give them permission because you don't opt out. If you go over to optoutprescreen.com, then when you go apply for a mortgage, in the next 24 hours, you don't have 50 mortgage lenders call you all at once because your data just got sold by the credit bureaus to all of these companies that want to market to you. So I just think it's interesting how people don't have their credit frozen right now. And I think, do you have a security system on your house? And they go, well, yeah. And I go, oh, so you must have been robbed. And they're like, no, I got the security system so I don't get robbed. Well, then why don't you have your credit frozen? At any moment, someone can steal your credit. Like they can apply for something in your name. If it's frozen, you know what they get? Nothing. They get nothing. They get a big old block that says, sorry, you can't until you unfreeze your credit. And it's about the best security system you can have to not have anybody suddenly show up, because then I get some scammer call, and if I'm off my, game that day and I accidentally we do it. Sometimes we do stupid things. Then, at that moment, yes, you need to go lock your credit card and the cards that are already on your credit. But once you call and freeze, if your credit's already frozen, you're okay. You know what I mean? It's kind of like the fire alarm is set here. Like we know that at least in this next few moments, they're not going to be applying for credit in my name. That part's safe. So I can't suggest that enough. Like if you really are concerned about other countries getting your data and stealing it, focus on the U.S. first. Focus on over here, the dark web and who's stealing your stuff today, because it's stolen. I mean, it's been breached several times. So do what you can to prevent that. And that, it doesn't, you can still work on your credit. It never hurts you to freeze your credit, but you do need to go to each individual credit bureau to freeze it. You can call one to do like a 90-day fraud alert, and it will put it on all 3, but then it goes away and then you're not protected. But a freeze, you have to individually with all 3 freeze and unfreeze when you go to buy the house. Worth
Got it. That's good advice. All right. Last question.
Okay.
Melissa, make
Yep.
it. Make it.
Gonna be like, okay, here we go. We're gonna go with this one. Relax Farms, because he's asked twice. What is the best advice for someone paying in cash?
Get married.
Don't call Alyssa.
Call me. I'm available. No.
don't call Alyssa if you're paying cash.
No, paying cash. What do you think? I mean, I'll tell you what, I've been reading a lot lately. I see a lot of celebrities that have millions and millions dollars mortgages. And what does that tell you? Is that their business finance manager is like trying to show his worth because they're giving him 10%, right? And so he's going in going, hey, I got something. You're going to get a mortgage because the rates are at 3 or 4% and it's going to be cheaper. And believe me, I know what I'm doing. And they're going to go, oh, I got a good finance manager. That's what I think. And so I'm seeing like Kim Kardashian taking out a $28 million mortgage. And you're like, you idiot, but is it an idiotic move? I don't know. So the point is that I see cash is king. Don't you think, Todd, as far as like being able to go out and really negotiate? Now, what are you, I guess more of the best advice for someone paying in cash? What expectations do you think people that are paying in cash have that they shouldn't? Because like, how you walk in thinking, if I'm going to pay cash, I'm going to get 50% off the price of the home. Probably not that much, but what do you think? Like,
I think it depends on your situation. So, if you are living within your means, the problem is that people want what they can't afford. And that's why they finance it for 30 years. So, if you have $500,000 in cash, you want a $3 million house. So I think it's, are you willing to live and buy something that you need, not taking it all the way out and to show off? I mean, and that's what I see. A lot of people are like, I have to live in this neighborhood. I have to buy here and I can afford it. If you have the cash and you can buy a house and not have a mortgage payment, man, God bless you. Why not? I say I'm all about it, right? Why pay the bank 7% at this point when you can keep that money for yourself? But I think that there's probably, if you think that you're paying cash because you're going to get the best deal, like Alyssa was saying, that would work if you're buying something that only cash buyers can buy. So if you're in a situation where you're buying something distressed to where, 85% of the buyers can't afford it, or they can't buy it because it needs such repair, and you can come in and swoop it up at, a big discount because you're a cash buyer and you can settle fast and cure everybody's, anxiety of, they need to go, they need to move down the road. I think, that's a power play. But I think if you're buying your primary, home, put enough cash down that you have enough cash that you can keep in the bank for emergency funds. Don't deplete all of your cash to not have a mortgage, because then you're in a situation of getting an even more expensive HELOC, to try and free some of that cash up. Real estate is not a liquid asset. So if you spend all your money and go, wow, man, that was really dumb, I wish I hadn't have done that, and now you're going to think that you can sell quickly or that you can get cash quickly, it's going to be very more expensive than if you would have kept some of your own cash on hand. I know that people that you're talking about, when mortgages dip down to 2.75, you'd be ridiculous to pay cash. Use somebody else's money at that point, right? But when we start seeing rates climb up to 7-8%, with the stock market being so, and I'm not a stock advisor, but with, some of the experts that are saying that, hey, we might have some serious times ahead, where are you going to put your money that is going to be safe and sound? I like real estate. I like as a permanence of investment. You can touch it, you can feel it, as long as you can go in for the long haul, like Alyssa said earlier. I mean, usually over the test of time, land values have gone up. Houses depreciate. People hate when I say that. Don't fix your house up and see how much it appreciates. It won't. It will fall apart around you. So your land value is what comes up, right? That's what appreciates the piece of property. That's why real estate is location Location. We love you guys. Alisa, thank you so much.
Thank you guys. I appreciate you.
Thanks for taking the heat tonight.
I can take it.
You can take it, guys. If you like the video, hit the thumbs up. And Melissa, thank you so much for hanging in there.
Thank you, Melissa.
And thank you so much. Thank you both. I mean, and Alisa, honestly, there's so much love on the YouTube channel. I mean, I
love you.
Yeah, they really
I didn't
appreciate
mean to be
you.
Yeah.
No, it's stinging. I get it. It's a little stinging at first, but you know what? You're tough and you can handle it.
Yes.
And we all can. And then at the end of the day, it's just a difference of opinion. So it's just the delivery isn't always the best. But yeah.
It is. We appreciate you guys.
All good. Thank
you.
And
we have some great videos coming up that we're going to post on our channel. If you haven't already subscribed to our channel, we'd love it if you did that now. Smash that thumbs up. Let us know that you like the video. Hopefully you did. If not, I guess you'll hit the thumbs down. And guys, make sure that you not only subscribe, but hit the alert bell. You'll know when we upload. I'm going to plug one thing here, guys, because we have a new channel. We are building content for it right now. It is called The Real Estate Agent. And if you're a professional in this industry, or you're like Alisa, you serve the real estate industry, it's a great channel. We are going to bring agents in. We're going to talk about what makes a great agent on this channel, guys, and even you as an audience you might pick an agent from this new channel that we have started, but we're building the content for it right now. If you haven't seen anything roll out and you subscribe to it, hey, it's coming. And guys, until next week, see you next time.
See you next time. Bye.